Hello there, and welcome to Market Call. I'm Paul Bagnall, and our guest today is Jamie Carrasco. Jamie Carrasco is portfolio manager at Canaccord Genuity, and you will recognize him, many of you will, as an expert in precious metals and also North American dividend stocks. So those will be the focus today. He's an expert in gold. He'll have plenty to say about gold bullion and gold stocks and North American dividend stocks as well. Our toll-free number is 1-855-326-6266. Our email address is marketcall@bnnbloomberg.ca. You can get your questions in that way. We'll talk to Jamie right now, and in our second break, after the first break, we'll get directly to your questions. So call those questions in, email those questions in. Jamie Carrasco is standing by to answer your questions. Jamie, happy Friday morning to you, afternoon, and thanks for joining us here on Market Call. I think a lot of investors, when they look at the run-up in gold to just south now of $2,000 per ounce, if they have not built a portion of their portfolio in gold or gold-related equities, regret not doing so. You say, however, in some recent market commentary that you would strongly disagree with the idea that they have missed the boat. You think there's still time?
I fully think that they have not missed the boat yet. I think it's important to understand that I've been on this since about 2012, 2013, saying that gold was going to be important. In 2015, up to 2015, I had my allocation at about 5%, and then I started increasing. And in 2018, I really started increasing very big, and I started tracking the indexes, because what gold to me is about what's happening with the central banks and the stimulation that these central banks are putting into the system, and that is creating some massive pressures within the monetary system that I think is repeating throughout history, like the 1930s. Now, if you look at the run up in gold, it really took off on July 20th after the Fed announced that they're going to do whatever it takes to keep this thing going. And let's go back to October of last year. Everybody's forgetting that the financial system was already in trouble. The repo rates were signaling that, and all of a sudden we have COVID-19, so it allowed for the Fed to print trillions of dollars to stimulate the economies, but I think the problem has gotten worse, not better, because of what's going on with COVID-19. So I do think that gold is still part of a portfolio, and it's really doing what it's done for 4,000 years, which is rising with systemic risk. And I personally think that systemic risk will continue rising. Look at the world we're living in. Look at what's happening with the politics in the U.S. coming into the 2020 election, the pressures between China and the U.S., the geopolitical tensions. Globally, I think everybody's starting to question governments, because of COVID-19. And it's funny because it's so indicative of a populist wave, exactly what happened in the 30s, the same level of instability. But underlying all that, I think it's important to understand that we printed all this money, but it hasn't entered the economy. It hasn't entered the middle class. The middle class in the U.S. has been losing out more and more. Yes, the 1% are doing really well, but not the 99%. So I think that is all indicative of a populist wave, of the net results of what happened when central banks start printing money. And it's funny because I look at it from the Chilean perspective, from the Latin American perspective, and I think globally we're going to relive through what Argentina, Brazil, Chile have gone through, and that's what I've been preparing for. That's where my experience is coming from, and that's why I like gold. Another important thing is, I don't know if you know Russell Napier, who I think is one of the best global strategists forever, and he's been holding on to a deflationary stance until about last month. Last month, he came out and he said that he's expecting 4% inflation by next year. Now, that's an important change, because what it's signaling to me is that the tsunami wave of all this money that's being printed is finally coming in. And one last important thing to point out is that look at Trump's policies, his presidential, whatever he signed over the weekend. What he's doing now is he's putting money right into the economy, right into people's hands. So now really the inflationary wave will start. And the fact that gold now is above 2,000 in U.S. dollars is another important signal, because gold was beating every currency except the U.S. dollar until now, and now what it's really signaling is that the U.S. dollar is also devaluing against the other currencies. So if we put it all
Okay,
together,
we're going to leave it there, Jamie.
However, before I answer that, I just wanted to finish making one last statement before we cut into the break, which was the fact that now that gold is above 2,000 versus the US dollar, that's an important signal because it's signaling that the currency reserve is also devaluing against gold. And if we follow that back in terms of how currency reserves have functioned, what we're really looking at is the currency reserve is in question, something that I've been talking about throughout for the last couple of years in terms of the setup that we're on. And I think that's an important signal going forward on what happens to gold versus the US dollar.
Welcome back. We are back with Jamie Carrasco. He's portfolio manager at Canaccord Genuity. His focus, of course, is precious metals and also North American dividend stocks. Let's get to Jamie's past picks. The last time, or a time in the past when he spoke to us was October 23rd, 2019, so just under a year ago. Past pick number one, Franco-Nevada, FNV on the TSX, trading then at $123.62, trading now at just over 195 Canadian dollars per share, total return of 58%, return of 58%, total return when you factor in dividends of 59%.
I'm still holding on to it. That's, again, one of the core holdings forever in my portfolio. I keep recommending it to my older clients. It's also in the equity income portfolio as part of the core. And it's the dividend. The dividend structure will continue to grow going forward.
Okay, number two is America's Gold and Silver, ticker symbol USA on the TSX, trading then at $3.78, trading now at $4.14. That's a return and a total return of 10%. Jamie?
It's a bit of a lagger, but I still hold it within my portfolio. I still like it. They're developing a couple of mines. They've had a couple of COVID issues, but I think going forward, everything's coming together for them, and they're going to have the leverage. One of the things about this company that I really like is they stayed alive through the whole worst of the low prices by mining the low grade. They're one of the few companies that hasn't touched the high grade, and by switching over to the high grade, which they began doing after higher $20 silver, we should be able to double the production because we're going from 50 gram per ton rock to 150 gram per ton. So that'll be really good for the company.
Okay, and the final past pick from October of 2019, October 23rd to be specific, the Dynamic iShares Active U.S. Dividend ETF, DXU, on the TSX. It's a U.S. dividend-focused ETF, but it does trade in Toronto, trading then at $32.99, closed yesterday at $39.24, a return and total return of 19%. Jamie?
I'm still holding on to this because I think that one of the things to understand about how I see things playing out is that once this debt mess is over, the dollar, gold, and the market are going to be at the same level. So I do think that if we're going into an inflationary wave, or if all of this money that is entering the system will continue to raise the market, gold is just going to catch up to the market. So I'd rather have both. The other thing is, this is in U.S. dollars. So the underlying asset of the U.S. dollars, I think, gives us quite a bit of, to the Canadian dollar, that is, gives us that foreign currency pickup, which is, I think, helps a lot in a client's portfolio.
Those are Jamie Carrasco's past picks from October the 23rd of 2019. We'll review them again. Franco-Nevada, the royalty specialist, America's Gold and Silver, ticker symbol USA on the TSX, and Dynamic iShares US Dividend ETF. We'll take a break. When we come back, we get back to your questions to Jamie Carrasco. Welcome back. Jamie Carrasco has been our guest on Market Call, but we're not quite finished with him yet. It's time for his top picks segment at the end of our program. Top pick number 1, Jamie, is Fortuna Silver Mines, FVI, on the TSX.
Yeah, with the 3 top picks that I chose for this show, I wanted to show the new additions that I'm doing outside of the core holdings of the portfolio. Fortuna being one of them, and what this is a producer developer. So what I like about this, first of all, it's silver, which I'm adding. They also produce in Mexico, but they're adding a brand new mine in Argentina. That's going to be one of the world's most profitable mines, and that should be started up by next year. Now, what's good about that is we're going to have production upside, but in the meantime, you're also getting the upside from the price of the commodity. You're getting it on the production. We have it with we rank it as a buy with a $6 target. It's past that target already, but it's one that I hold in the portfolio. I've recommended it in the past, and I continue to acquire it for new clients.
Okay. Number 2 is Calibre Mining, ticker symbol CXB on the TSX.
Yeah, this is a growing low-cost producer in Nicaragua. They have 2 mines that have already started up, and those mines will continue to grow. It's very low cost, and there's also exploration because when they built up these 2 mines, which I believe they bought from B2 Gold, they haven't fully explored the area. So here we're also going to get some exploration upside, further exploration upside from the play. And exploration, I think it's the area that you want to be looking at, not for your whole portfolio. And don't just think of explorers as producers because they're looking for gold. They don't have gold yet. We have it as a buy with a $3.10 target.
Okay, and number 3, final top pick of today's segment, New Legacy Gold. This is a venture-traded stock. Ticker symbol NUG on the TSX Venture Exchange. New Legacy Gold, Jamie?
This is strictly speculative. So it goes back to my question earlier: did you want speculation, or do you want production or an investment? Well, New Legacy is an explorer developer in that they're looking for. They think that they have identified a Cortez district type of in Nevada. There's some really big deposits that have been discovered in the past. That's a Cortez trend, and they think that they have something similar to that. Sorry, a Carlin, the Carlin trend, and they believe that they have something similar to that on the ground. Now, it's interesting because Metalla Royalty just bought a royalty stream from their neighbor property, and if they have the same thing as the neighbor property, well, this thing is going to be worth quite a bit of money. Another thing that I like about this company is the fact that they've been attracting a lot of ex-Barrick top senior people have been moving over there, so I think they have a good feel for it. And again, this is an exploration upside. What's great about exploration that if you start finding it on the ground, the value of the company will grow exponentially. And that's why you want to have exploration, but it's not the sole focus of my portfolio. Like an exploration play, I would be putting 10% of my gold positions into it and have at least 5 of them. So this is one of them, and I have mentioned others in the past. But it's not, I wouldn't be putting all my money in exploration. You want it in solid gold producers.
I just want to ask you a question about your first top pick, Fortuna Silver Mines. What is your view of silver, the metal? I know we got a question on that. There's the silver ratio. It always trades, of course, at a lower price than gold, but investors and experts like yourself watch the ratio between silver and gold. How much upside do you think there is in the silver price?
Well, silver has to get to at least 40 to get to where gold is right now, because that's where it was in 2011, and it hasn't moved. I see it more like the slinky analogy in that gold has run away. We're sitting at 2,000. The HUI is at 350, just starting to catch up to 700. And silver itself, well, the why we look at the gold-silver ratio is because we uncover from the ground for 1 ounce of gold that we pull out. I believe we pull out about 17 ounces of silver. So historically, over time, the spread between gold and silver has always been about 30. If it gets, right now we're at 75, if we get to 40 times, anywhere near 45, silver has way more room to go, and I think that's coming. We're there. The reason why silver moves last is because silver is poor man's gold. You know, when the regular average Joe gets it and they go and buy some physical gold at $2,000 an ounce, and then they realize, oh, wait a minute, I can buy some silver for $25 an ounce. Well, that's when the demand shifts. and then the price takes off. That's why it takes time. You just have to have the patience. Same thing with the leverage of the silver producers as well. They're going to be catching up, and they're going to have even better leverage than the gold producers because of the rapidity at which silver moves. Okay, that's why I've overweight the silver.
Jamie Cross.
The silver. Yeah.
Jamie, we want to thank you a great deal on behalf of our viewers for all your insights today into gold, silver, and dividend-paying stocks. Have a great weekend, Jamie. Thanks a lot for your contributions today.